Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be talking about flows that occurred during the week ended February 27th, 2013. And basically, we're going to talk about the conventional fund business. You know, we've all been hearing, just the bad news out there. And the bad news has been that Congress can't come to an agreement with the president and with themselves to stop this thing called sequestration. Well, that was frustrating for investors, and so they basically kind of took a hold and wait and see type of approach. But also, we heard news that Italy had a reformation of their government as well, and came up with news that, in fact, maybe they're going to have some problems with their austerity program. So that kind of put a pall over the general markets as a whole. We saw just a really big increase and decrease in the VIX, that's a volatility index or a fear index, and basically we still had investors actually plow money back into the conventional fund business. About $9.7 billion ended up into that area. So despite having these bad news, people still continue to put money back to work in conventional mutual funds. We'll talk a little bit more about that later in detail. Let's take a look at the macro group to see who received the money and how they received it. Equity funds saw about $2.8 billion of net new money come into their coffers. Again, amazing feat considering how much volatility we had. Taxable bond funds took in an amazing number again, $2.9 billion. That's again above the average. We've been seeing a little bit lower numbers here recently. Muni bond funds were able to take in about $300 million, and then money market funds saw about $3.6 billion. So really overall, we saw a whole bunch of money coming into all four major macro groups, and that was quite a story. But now let's take a look to see how equity funds got that. And again, this is a tale of two cities, so we'll talk a little bit more as I break out ETFs. But the first part we're going to talk about is conventional fund business. Despite having the second downside performance in 2 weeks, basically we saw a 0.07% negative return, not a big deal. Basically, we saw about $2.8 billion come into the conventional fund business via equity funds. And again, this is the 8th consecutive week that we've seen it. Year to date, we've seen $49.7 billion come into the equity arena. And in fact, we know that the equity arena has been somewhat of a pariah of sorts prior to this run of the last 8 consecutive weeks of inflows. Well, when we take a deeper dive, we see domestic equity funds took in about $0.8 billion of net new money. It's the second consecutive week they've seen money inflows. And non-domestic funds took in about $2 billion. Now, of that breakout, we see that large cap funds, again, was a big attractor for equity investors. They saw about $367 million of money come into their coffers, while emerging market funds saw about $1.1 billion of money coming in theirs, and that's certainly been a long-standing story. Investors obviously are looking for growth and opportunities to work their money abroad, and emerging markets seem to be the place to go. Well, let's take a look at the equity ETF side, and this is the tale of two cities I was talking about. We saw redemptions of about $3.8 billion. That's the second week in 3 that we've actually seen redemptions as well. The big loser was GLD. Obviously the price of gold has been going down. We saw about $2.1 billion go out their coffers, and then we saw the Spider S&P 500, SPY, lose about $700 million as well. Now, on the flip side, if we take a look at who took in money, we see Wisdom Tree, a Japanese hedge equity fund, taking about $300 million. iShares Dow Jones United States Real Estate Index Fund taking in about $300 million as well. So when we took a look at this, we saw people basically going after some income dividend plays and the like, but we saw people basically running from the big behemoths that we've been watching inflows going in there. And I think this is really just a lot of people taking money off the table before the sequestration hits, and just having some general concerns that the market has just been too hot too long. We have about a 6% return for the 2-month period that we've started so far, and again, people are expecting a breather to come in. Well, let's take a look at fixed income funds. Fixed income funds took in a lot of money. People saw two things. They were basically going for yield and also going for some safety plays in case of interest increases, if the economy is doing too well. So for the 17th consecutive week, we saw inflows about $2.9 billion. It's the first week in 3 that we've actually seen plus side returns. Just a minute amount, 0.13%. But where we saw the money going was, again, bank loan funds. This is loan participation funds, bank rate loan funds, whatever you want to call them. This is the readjustment type of funds. It's adjustable rate funds that basically are going to take in money. If we see interest rates rise, they're going to benefit from it. Bank loan funds saw about $1.2 billion of net new money come into their coffers. This is the 37th consecutive week and their second best inflows to date that we've been doing since we've been tracking funds in this particular arena since 1992. Flexible portfolio funds or flexible income funds, so about $1.4 billion in net new money, and this is the 10th consecutive week that we've seen flows into this group. Well, let's take a look at ETFs on the bond fund side, and as we know, taxable bond funds are not a big area of inflows and just not a big area of interest, but we did see one of the best weekly inflows since November 7th, 2013 or 2012. So we saw about $1.1 billion in net new money come into their coffers, with iShares 20 plus Treasury fund taking in about $333 million, and then we saw the ProShares senior loan par, and again this is that loan participation piece, taking about $140, and high yield funds were kind of at the bottom. So not a lot to talk about with the taxable bond funds, but certainly something that we've been keeping an eye on, because again, really good numbers coming in, and again it's been people doing a play towards yield plays and also maybe some sort of interest saving play as well. Well, let's take a look at muni bond funds. Muni bond funds for the second week in 3 were on the plus side with about a 0.24% return. Now this is the 9th consecutive week that we've actually seen inflows into this group, and it was about $312 million. Not a lot to write home about, but again, it's that 9th consecutive week, people having a little bit more comfort level going after these tax-exempt muni bond funds. Now, national municipal debt funds basically took in about 263, or the lion's share of those flows. Well, that brings us to something we haven't seen in about 4 weeks. We saw flows into money market funds, about $3.6 billion. It's the first week in 4 that we've seen money go into this group. Taxable money market funds took in $4.7 billion, and the breakout was quite drastically different. Institutional investors padded the coffers about $4.8 billion, while the retail investor actually took out about $0.1 billion out of there as well. But if we take a look at the tax-exempt sites, remember, for about 3.6 total came in to the whole business, and part of that was the reason why was we saw taxable tax-exempt money market funds lose about $1.1 billion in flows from their coffers. So overall, it's kind of a lackluster story. If we talk about flows in munis and maybe even money market funds, wasn't that big of a deal, but certainly we saw some industry trends continue. Maybe investors a little bit late to the party, putting money back to work for equity funds on the retail side. But I think we're going to have to keep our eyes on the idea that this morning personal consumption came up with kind of disappointing results, only up about 0.2%. But one of the big numbers that came out later on in the day was the ISM manufacturing number came in at 54.2, much better than it was expected. So we could actually see some good news continuing on. Well, we won't know until next week, but if you want to do a deeper dive until then, you can go to lipperusfundflows.com, do a deeper dive on the data, or if not, you can join us next week where one of our analysts will talk to you about flows trends for that particular week. Well, thank you for joining me. My name's Tom Rosine, wishing you the best in your wealth planning and creation.